Hello, welcome back to the Intelligent Investor series. Chapter 2, The Investor and Inflation. This chapter is an introduction to inflation. Again, Graham uses very specific historical numbers and data to discuss rates of inflation and their effect on investment performance, the relative merits of investing in stocks versus bonds when keeping inflation in mind, and so on. Inflation is an economy-wide, sustained trend of increasing prices from one year to the next. An economic concept, the rate of inflation is important as it represents the rate at which the real value of an investment is eroded and the loss in spending or purchasing power over time. Inflation also tells investors exactly how much of a return their investments need to make for them to maintain their standard of living. The easiest way to illustrate inflation is through an example. Suppose you can buy an ice cream for $10 this year and yearly inflation rate is 10%. Theoretically, 10% inflation means that next year the same ice cream will cost 10% more or $11. So, if your income doesn't increase by at least the same rate of inflation, you will not be able to buy as many ice cream. Graham begins this chapter by noting that there is no close time connection between inflationary condition and the movement of common stock earnings and prices. The chapter begins by explaining how inflation needs to be in your consideration of not just your end investment success, but in choosing an investment vehicle that performs best in an given inflationary circumstances. Benjamin Graham believes that inflation can add little to common stock values. Graham focuses immediately on the concepts that inflation will be felt most with portfolios that focus on fixed dollar income rather than ones that vary with the market, essentially stating that high-quality common stocks have typically been able to better accommodate desired returns during periods of high inflation. He is comparing this to bond yields that would typically be eaten up by inflation. He admits through that stocks may perform better than bonds, but there will be always two influences on those equity markets. Graham's reasoning here is as follows. Number 1, periods of inflation increase the cost of borrowing money. Number 2, this increased borrowing cost reduces the return which utility companies receive on their invested capital. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged on the regulatory process. But this may be the place to remark that the very fact that the unit cost of electricity, gas and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their shareholders in the future as it has in the inflations of the past. Benjamin Graham advises, just because of the uncertainties of the future, the investor cannot afford to put all his funds into one basket, neither in the bond basket. Despite the unprecedentedly high returns that bonds have recently offered, nor in the stock basket, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against the unexpected and the disconcerting in this part of his life. It is axiomatic that the conservative investor should seek to minimize his risk. The rest of the words to be continued. Don't forget to like, comment and share and subscribe Weekend channel.